Okay, session number 7. And in this session, I will go into details on valuation and the methodologies for valuation. In the previous session, I made reference to the 3 approaches that could be used to value a property. The first I said was intrinsic valuation. The second and the third I said could be called relative valuation. But for the second, I made a reference to what I called pricing. And by pricing, I'm referring to construction cost approach. The second is pricing. However, this applies what we call a comparative approach. And let's quickly go into each of those. I'll start with intrinsic valuation because I believe this should be your guide. And I believe this is the main approach that should be used if and when you decide to purchase a property. Now, let me start by saying this. What is intrinsic valuation? Well, to understand intrinsic valuation, you have to understand different asset types. Assets can be grouped into a number of categories. There are assets that produce cash flow. There are assets that are held in a form of currency. And then there are assets that are held. These assets produce cash flow also. And then there are assets that are also held in what I would call currency, non-cash flow. You could even go as far as saying that there are assets that are non-cash flow producing. Let me give you examples. An apartment building or a commercial building that is rented would be a cash flow generating asset. A business that generates cash flow would be considered to be in this category. This second category of cash flow, but denominated in a currency, would be something like bonds. A bond is simply a promise to pay to deliver money at a future date. So you buy a bond and the bond promises to pay you 2% interest annually. That means it will produce cash flow. And in order to identify the value of this bond, you can use the cash flow generated by the bond to calculate its intrinsic value. And then there are assets that are denominated in a currency, but it's non-cash flow producing. So for example, this would be something like holding money in cash. Cash does not have any intrinsic value because it does not generate any cash flow. And there are non-cash flow producing assets, such as gold and some other commodities, such as, depending on where you fall under, I would put the likes of cryptocurrencies in this category. They do not produce cash flow. Therefore, they have no inherent intrinsic value. So intrinsic valuation is simply used for assets that are cash flow generating. And that's the methodology we will use. Now, let me set this aside and we go very quickly. You found the house. Let's assume, for simplicity, you're about to buy flat number 2 in this building. The building is priced at 500,000. The question is, should you buy it? Well, we'll go through a step-by-step process. Let's estimate the intrinsic value. The first step is to say, well, the intrinsic value is simply the present value of all of the cash flow this building or this flat will generate over its entire lifetime. We'll assume that you intend to hold the building for 10 years. So this would mean cash flow year 1 all the way up to year number 9 and then number 10. And on year number 10, this building will be sold. The first step of estimating the intrinsic value of an asset is you assume what we call going concern. This simply means that it will continue to operate for the foreseeable future. Step 2, you then have to estimate the cash flow every year. And then once you have the cash flow, you have to discount this cash flow back at a discount rate. So the intrinsic value of this property would be cash flow generated in year number 1, discounted back at a discount rate, year number 2 at a discount rate, all the way up to number n, which n will represent in this case the 10 year n. But you don't have to take what we call the terminal value, which is liquidation value of the asset, and discount it back also back to today's present value. So let's make this more practical. Property is sold, or rather is priced at 500,000. It's a 2-bedroom flat. Let us assume that this property, if rented, will generate £1,500 per month. This £500, we will assume that this £500 is simply the sale price. At £1,500 every month, this is equivalent to 18,000 annually, every year. So what we will try to do now is estimate what the value in terms of its intrinsic value would be. Purchase price 500. Let's assume that we will be paying purchase taxes. In the UK, we call it your stamp duty tax. Let's say, for simplicity's sake, this is 10,000. You have a solicitor and all of the costs she will charge, searches fee, etc. Let's say it's 5,000. Usually it's less than this, but it depends on the value of the asset you're buying and the extent of the works that is required. Let's also assume, for simplicity, that there is another, what I'll call miscellaneous fee of 5,000, which brings your entire purchase to 520,000. Okay. Once you bought the property, let's assume you make a gross revenue from rental of 18,000. However, in order to estimate the cash flow, you have to make sure that you distinguish the difference between net income and cash flow. They are not the same. To get to net income, what you simply do is you take your revenue, you subtract what's called the cost of goods, or the amount of money it would cost you to generate this revenue. So this could be advertising fee, this could be search fee, listing fee, doesn't matter what that is. But whatever you spend in order to generate this revenue, this would then give you your operating income. Then you subtract what we'll call sales, administration, and general. This would also include depreciation, which ideally should be in this section, but it doesn't matter where you put those. Cost for management. So if you have a managing agent, you would allow their cost. You would also include any cost for repairs, cost for insurance, cost for lost rent or vacancy. This would then give you the operating income. I'm going to go back, I've made a mistake. Operating income is here, not there. So if I take your revenue, you take out the cost of goods sold, and that gives you your net revenue. Apologies for that, that's an error on my part. This gives you operating income. The next part is you then subtract any financing cost. So if you have a mortgage, this is where you would subtract the mortgage cost. The balance of this will give you your net income. I'm going to make this simple for you. You start with revenue. All of these costs we'll call operations and capital expenditure. Then you subtract financing cost, and that gives you your net income. It's really that simple. However, to go from net income to cash flow, what you must do is recognize that depreciation is a non-cash expense. Now, I hope this is not too confusing. This is an accounting provision, but it's a non-cash expense. What this simply means is when you buy a building, assume that the building has been newly constructed. A newly constructed building will have a 50-year life. This would imply that every year, the value of the building in terms of its functionality, its visual aesthetics, the value of the building in terms of its the economics, functionality, and use would depreciate over time. Just like any asset you might have, you buy a piece of shirt, the more you wear it, the more it depreciates in value. If you have an oil well and you have oil, the more you draw down the oil, the more you deplete the oil. So for buildings, in accounting terminology, we are allowed to deduct a depreciation allowance. The depreciation allowance is useful because it saves you taxes. So if it's a 50-year life, which you assume, then you would say every year the building goes down by 2% in its value. That's simply 1/50. So you deduct a depreciation allowance of 2% of the purchase price. So this 500,000, you would say this 500,000, every year you would deduct 10,000 from your net income. From your revenue to obtain your net income. But it's an accounting term. In order for you to measure the cash flow from the assets, what you're trying to do is simply look at how much money came into the business and how much money left the business. How much money did you spend on the property and how much money did you make from the property? In other words, cash, not net income. This refers to what we call accrual income. It's money you accrue over time, but it is not cash income. To go from net income to cash flow, you then have to make some adjustments. The first is you take your net income and you deduct what we call your net capital expenditure. Then you deduct what we call working capital. And you deduct finally any money raised from debt or money paid back based on the debt you owe. For your property, this will not apply, and you can take that out. These two would apply primarily for businesses. So to make it very simple, all you have to focus on is your net capex. Now let's move to the next stage. So effectively we're saying your net income to get to cash flow less net capex. Now, what is your net capital? Your net capex is your net capital expenditure, meaning money expended, which is simply obtained. The longer form of this equation is simply your net income. You add back your depreciation and you subtract capital expenditure. So this simply means we had previously subtracted depreciation. But remember, when we use depreciation in this part of the calculation, there was no cash outflow. It was simply an accounting expense. So what we do is we add back a depreciation. So in this case, you add back the 2% of the purchase price that you subtracted previously. Then you subtract any capital expenditure spent. It's important. So any maintenance, preventative maintenance, any repairs, any modifications you've made to the property. This gives you your cash flow. This is actual cash in your pocket. To make matters more easy to remember, you're making 18,000 every year. Let's assume your operating cost in everything, operating cost is 3,000 annually. Let's assume this gives you 15,000. Let's say you have, in this case, deducted 10,000, which is depreciation. This gives you 5,000. You then subtract 0 for your finance cost. In this case, we will assume that you purchased the property with cash. So you haven't actually taken out a mortgage. This leaves you with £5,000 net income. To get to cash flow, we take your 5,000, we add back the depreciation, which is 10,000. Then we subtract any cash outflow on capital expenditure. CapEx is simply money expended for the long term to improve the value of the asset or to improve cash flow. Working capital is any money expended in the short term. In other words, the focus is on short-term benefits to improve the cash flow. I mentioned previously you can exclude the working capital because this is just one house you're buying, and therefore you do not have inventory, you do not have any form of payables, and you do not have receivables. So we can put that aside. You add back 10,000. Let's assume that you've spent 3,000 for your capital enhancements. This would mean you have 15,000 less 3,000. This is 12,000. So your cash flow every year is 12,000. So we have your cash flow, which is one part of the equation. 12,000. The question then is, what is the discount rate that you would apply to discount the cash flow in the future? Well, in this case, I've used equity financing. I haven't used debt financing. I will cover these in a different session. I will use roughly 7%. This means that the cost of equity is 7%. Had I borrowed money for this purchase, assuming that I had made a 10% contribution of equity and the bank provided 90% through a loan, then what I would have would be some debt financing and some equity financing, which we would call the cost of capital. This would simply be 10% of 7% plus 90% off, in today's terms, in the UK, is roughly 3.5% for borrowing, for getting a mortgage. This would mean that I haven't done the numbers, but I can do it very quickly. This would give me 0.2, which is 3.85%. This would then be the discount rate I would use to discount this 12,000. It's important you understand this, but please do not focus on this for now. I will cover these in a different session. This would mean that my discount rate will be 1 plus 0.07. Let's assume that this £12,000 would increase every year at the rate of 5%. I would then have year one. Let me start. Year one, 12,000. Year number two, 12 times 1.0. Let's say 3%. 5% I said. 1.07. Year number two. And you carry on until you get to the 10th year. What this simply means is that by the end of the first year, that 12,000 only 11.21 thousand. By year 2, this will be 11.0 thousand. By year 3, this will be 11.33 thousand. The point of this is you keep adding all those 10 years, and then you get to the end of the 10th year. As a matter of fact, if you would not mind, I understand I may not have so much time, but let me just carry out this calculation for the 10 years so you get an idea of how this works. So this is year number 3. This is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, let's go. 12, 1.07, 4, 12, 1.07, 5, 12, 1.07, 6, 12, 1.07, 7, 12, 1.07, 8. This obviously is times 1.05, 4, 1.05, 5, 1.05, 6, 1.05, 7, 1.05, 8. Let me just do that very quickly. So this is up to year number 8. We'll do the number 9 and number 10. So for number 9 and number 10, it's 12 times 1.05 for 9 years, divided by 1.07 for, where's the power 9, which is 10.12. And then number 10 for the 10th year. 12 times 1.05, 10. It's 9.936. What we then do is we add all of the cash flow. So we add 9, 10, and all of these numbers. This will give us plus this gives us 96.45 over the 10-year period. That's the total cash flow you would get. That's all the cash you've generated, free cash flow you generated from this asset over the entire life, which is 10 years in this case. However, in year number 10, you have two options. You can say, I have what's called a terminal value. I can sell this property, or I can assume that I will not sell the property and it will continue to generate cash flow for the entire duration of its life. Two options are available. If you're selling the property, you simply use what we call the liquidation price. In this case, we had assumed, now you cannot magically choose a number. You bought the property for 500 and it's increased by 5% every year up until the 10th year. So this is quite easy to find out. 500 times 1.05, 10 years. So you would say by year number 10, the property is worth 814,400. However, you then have to discount this back to today. So it would be 814,000 divided by 1.07 because you used equity raised to the power 10. So it would be that would mean that this is the present value of the property 10 years into the future, discounting it back. So to bring in all of the cash flow you generated from the asset, you would add all of this to this, which is simply 414.4 plus 96.45. 96.45. $510.47. This is the intrinsic value of the property. Now, please stay with me here. I have taken the time to go into detail on how these calculations are performed, simply so you have some clarity on how to do this. We've estimated the intrinsic value of this property, and we've said it's 500,470. This is the intrinsic value. Can you remember what the purchase price was? Purchase price is 500. However, the total purchase cost was 520.